Hello and welcome to lecture number 3. My name is Nathan McNamee. I'll be your instructor for this lecture. We're going to be discussing financial leverage and capital structure policy. And this has a lot to do with how companies choose to finance their operations. Financial leverage is when they borrow. The capital structure policy is the decisions that management make um, uh, that determine how much debt to bring on, how much money to borrow, or how much equity to sell. There's some theory we'll be going through in this lecture that suggests that there might be an optimal capital structure. So we'll get into some of that. First, let's just discuss the key concepts and skills that we'll be covering. We're going to explain the effect of financial leverage on companies. We're going to show the impact of taxes and bankruptcy on capital structure choice. And when we go through that, we'll be discussing some theory, some very famous theory in finance that you definitely need to be familiar with. And we'll describe the essentials of the bankruptcy process, which of course, debt and the way companies are financed can eventually lead to bankruptcy if the companies don't do well, and how that affects some of these capital structure decisions we'll be discussing. So let's start out with capital restructuring. When we talk about capital restructuring, we're talking about capital structure, so how much debt and how much equity is used to finance the firm. Companies will often need to restructure. So we're going to look at how changes in capital structure affect the value of the firm, holding everything else equal. We're going to discuss capital restructuring and how it involves changing the amount of leverage a firm has without changing the firm's assets. And we'll discuss how the firm can increase leverage by issuing debt and repurchasing outstanding shares. Finally, the firm can decrease leverage by issuing new shares and retiring outstanding debt. So they can sell new shares, take the cash, pay down outstanding debt, and so that affects capital structure. And the point before that, the firm could borrow more and buy back some of their shares from some of the shareholders. So these decisions have a potential effect on the value of the firm. And as financial managers, our role is to maximize the value of the firm. But the question is, for who? For the shareholders? For the people who we've borrowed money from? For other people? Governments? So it really depends on the point of reference. But in general, we say our role as managers, financial managers, is to increase the value of the firm for the shareholders. So how do we choose a capital structure? And every industry is a little different in the as there's kind of norms and capital structures. So question we ask is, what is the primary goal of financial managers? I already mentioned this in the previous slide. We maximize shareholder wealth. So we want to choose the capital structure, the mix of debt and equity that will maximize shareholder wealth. And we can maximize shareholder wealth by maximizing the value of the firm or minimizing the WACC, weighted average cost of capital, which we covered in Finance 3250. So the lower the weighted average cost of capital, the higher the value of the firm in general. So how does leverage or borrowing affect our firm? We're going to discuss how it affects the EPS, earnings per share, and return on equity of a firm. When we increase the amount of debt financing, when we borrow a lot of money as a company, we increase the fixed interest expense. So on a loan, let's say it's a loan of $1 million and we have to pay a 10% interest on that. 10% per year would be $100,000. So that is that fixed interest expense that is expensed every year at the company. So if we have a really good year, then we will pay our fixed costs and we have a lot of money left over for our shareholders. However, if we have a really bad year, we'll still have to pay our fixed costs and we'll have a lot less left over for our shareholders. So leverage, we call it leverage because when we borrow money, it amplifies the variation in both the earnings per share and the return on equity. And that's because we're using debt to finance our operations, which means that for the shareholders, they didn't, the funds that were raised through equity are less. And so this leverage, this borrowing, levers up the company, allows them to do a lot more than they could with only the equity that they raised. And so when times are good, leverage is a great thing. When times are bad, that fixed interest payment, those fixed costs can be sometimes very difficult to pay. And we'll discuss the effect of bankruptcy here in just a little bit. Okay, so now we're going to look at an example of financial leverage and its effects on earnings per share and return on equity. For this, we'll ignore the effect of taxes at this stage, and we'll bring taxes in a little bit, and that does affect the decisions that we make. So the question is, what happens to earnings per share and return on equity when we issue debt and buy back shares of the stock? So we start off with 100% equity as our capital structure. We're going to borrow some money, issue debt. We're going to take that money and we're going to buy back some of the shares of stock. And so the capital structure now has both equity and debt in the capital structure. And so I'm going to open up this Excel spreadsheet, which gives us an example of financial leverage and its effect under different circumstances. Okay, so in this spreadsheet, we see at the top in the current column, this is the current capital structure. There's $5 million worth of assets, and that was financed through $5 million worth of equity. Our current share price is $10 per share, and shares outstanding is 500,000 shares. And so that's the current structure. Now the proposed structure is we'll still have $5 million worth of assets, but we're going to issue $2.5 million worth of debt and buy back half of the equity. So our share price remains the same in this case. Our debt to equity ratio is now 1 because they're the same. 2.5 million divided by 2.5 million is equal to 1. But the number of shares outstanding has decreased. So we've got less shareholders and more debt. So now it's a 50-50 debt structure. So looking at these two tables below, you can see what effect the recession and an expansion periods might have on return on equity and earnings per share with no debt. So this is our current capital structure, 100% equity. You can see the ROE during a recession is 6%, earnings per share is 60 cents. During an expansionary period, meaning things are going well, the ROE is 20%, earnings per share is $2. So that's great. Now, what happens when we leverage and we buy back some of that equity by borrowing some funds? Now we've got debt and we've leveraged up our company. And you can see during the recession, so we've got our earnings per share, our earnings before interest and taxes, which is the same regardless of the capital structure, but we've added an interest expense. So you can see that interest during a recessionary period really eats into our net income. It's a fixed cost. We have to pay it no matter what. Return on equity is significantly affected at 2%. Earnings per share is only 20 cents per share compared to the 60 cents under our no debt capital structure. Where leverage really is an advantage is if we think that the company is going to do well. that we're going to have an expansionary period. And so we have the same earnings before interest and taxes. The interest is the same regardless of whether we're in a recessionary period or expansionary period. The net income is a little lower, but when we think of it in terms of equity, we have a lot fewer shareholders, a lot less equity outstanding. So the remaining shareholders, the shareholders that own the 250,000 shares, their ROE, return on equity, is 30%. It's a huge return on equity, and their earnings per share is $3, which is much higher than with no debt. And so there's a risk here, and a lot of companies that see expansion in their future tend to lever up. They tend to want to have a little bit of financial leverage, because then the return to the equity, return on equity, the return to the shareholders is much greater. Our example of financial leverage, there's variability in return on equity. Looking at the current structure with no debt, the ROE ranges from 6% to 20%, depending on whether we're in a recessionary period or an expansionary period or somewhere in between. With the proposed structure, issuing debt, borrowing money, paying off or buying out some of the existing shareholders, we reduce the amount of shareholders. Our proposed structure would give us an ROE which ranged from 2% to 30%. So it increases the variability of the potential returns to our equity holders. And as we look at the same variability in earnings per share, you can see with the current, it's between 60 cents and $2. With the proposed, it's between 20 cents and $3. So yet again, it makes a big difference there. So the variability in both ROE and earnings per share increases when we leverage. And so it increases the potential positive return, but also brings some additional risk because of the fixed interest payments that are involved. So how do we make the decision? How do we know where we would want to come in at as far as our capital structure and whether or not we want to borrow money and lever up our company? Well, there's a way to look at it, and we'll look at the spreadsheet again. We call this the break-even EBIT. At what point does it make sense? What level of earnings before interest and taxes does it make sense to lever up our company, to borrow? So first, the way we do this is we find EBIT, earnings before interest and taxes, where the earnings per share is the same under both the current and proposed capital structures. And if we expect EBIT to be greater than the break-even point, then leverage may be beneficial to our stockholders. However, if we expect EBIT to be less than the break-even point, then leverage is detrimental to our shareholders and will harm us. Let's go back out to that spreadsheet where I can show you a chart which illustrates this. Okay, so as you can see here, we've got our break-even point, which is where it's the same under either structure, proposed capital structure or the current. And so if we as management feel strongly that our earnings before interest and taxes is going to be greater than the break-even point, if it's going to be on this side of the graph, then we will want to lever up our company. If we think there's a good possibility that our earnings before interest and taxes will be less than the break-even point, then we would keep our current structure and would not borrow anything. So going back to the PowerPoint, this is an illustration, a further example of how we would calculate the break-even EBIT. And so what we do is we set the current versus the proposed structure equal to each other. and then we solve for EBIT. And so the EBIT there under both structures is 500,000. That's our break-even EBIT. And so the break-even earnings per share is $1 per share, as we can see that. So thinking back to the graph that I just showed you, if earnings before interest and taxes is greater than 500,000, then we'll want to lever our company, borrow those funds. If it is less than 500,000, then we'd want to keep our current capital structure. So just a summary of this slide, we set the earnings per share of both the current and the proposed structure equal to each other. So we're looking at this, we've got EBIT divided by 500,000 shares. That's our earnings per share. On the other side, we've got our EBIT minus the $250,000 of interest that we have to pay, but we're dividing it by 250,000 shares. So when we set that equal to each other, we can figure out what that break-even EBIT is. So a few conclusions on our corporate borrowings. Based on what we've seen so far, we can draw the following three conclusions. First, the effective financial leverage depends on the company's EBIT. When EBIT is relatively high, leverage is beneficial. Under the expected scenario, leverage increases the returns to shareholders as measured by both ROE and earnings per share. And shareholders are exposed to more risk under the new proposed capital structure because in this case, the earnings per share and ROE are much more sensitive to changes in EBIT. And so as financial managers, we'll want to hopefully have a very good feel for where we would expect EBIT to be in order to be able to make those decisions. So where does that leave us with corporate borrowing? There's another concept that we need to cover called homemade leverage. So in the previous slide, you'll recall we came to some conclusions about corporate borrowing. On this slide, we're tempted to make a fourth conclusion. And this is our fourth conclusion that we're tempted to make. That because of the impact that financial leverage has on both the expected return to stockholders and the riskiness of the stock, capital structure is an important consideration. Unfortunately, this is not correct, assuming we're in an environment of no taxes. And that's because shareholders can just adjust the amount of their own individual financial leverage by borrowing and lending on their own. So a company could be 100% stock. The shareholder could go borrow some money and buy some additional stock in order to have this leverage. And so we see that a lot. When I worked in the investment world, we were able to provide leverage to investors if they so choose. Again, it made things a little bit more risky, but they were able to borrow or lever up their accounts. And in most cases, my clients could borrow up to 50% of the value of their account. So that would allow them to buy additional stock, which if things went really well, the leverage was a wonderful thing, but if things went poorly, it also amplified their losses. So this homemade leverage is an important concept to remember for the exam as well. Okay, and also the use of personal borrowings can alter the degree of financial leverage, which we already discussed was homemade leverage. Okay, so here's an example of homemade leverage. The following example illustrates that it actually makes no difference whether or not the company adopts the proposed capital structure, because any stockholder who prefers the proposed capital structure can just simply create it on their own using homemade leverage. So with the proposed capital structure, we'll buy 100 shares within the proposed capital structure, and that provides the same outcomes as buying 200 shares within the original capital structure. So buying the extra 100 shares would require the investor to take on a loan for $2,000. Remember, it was $10 per share. This assumes that the investor can borrow at the same interest rate as the company. So in the end, it really doesn't matter to the shareholder whether the company does it or whether the shareholder does it, because in the end it will be the same. So the proposed capital structure versus the original capital structure with homemade leverage. We've got the three different scenarios: recession, expected, and expansion. So you can see the earnings per share is 50 cents up to 5.50 in this example. So we have 100 shares at $20 per share. Our original capital structure and homemade leverage. Down below, we buy $200 a share and borrow the $2,000, and so we end up with the same. Whether it's the proposed structure, we buy less shares because they're already levered, or we with the original capital structure, the current capital structure, we buy 200 shares and then we can borrow ourselves. And the net cost is the same. And so it really makes no difference. The point here is different investors have different risk preferences. And so with all else being equal, it's better to leave it up to the individual investor to decide whether or not to leverage up their investments. That brings us to the next section of slides. So if you need a break, this is where you would take a break. We're going to be discussing now capital structure theory. And this is a very important theory. It'll be discussed in other finance classes. And it really sets the stage for our understanding of how to make capital structure decisions. And this theory came from Modigliani and Miller, M&M. The Modigliani and Miller theory of capital structure is what we call it. And so you'll hear Modigliani and Miller all the time referenced both by academics and in corporate boardrooms. So they have, as part of their theory, a proposition 1, a proposition 2. So the proposition 1 has to do with the effect of capital structure on firm value, and we'll dive deeper into this. So just remember, proposition 1 has to do with firm value. Proposition 2 has to do with weighted average cost of capital. So the cost of capital and how that affects the value of a firm. And so with proposition 1, firm value, proposition 2, weighted average cost of capital, you'll see this all come together here in a little bit. The value of the firm is determined by the cash flows to the firm and the risk of the assets. So there's a changing firm value when we change the risk of the cash flows, or if we make a change to those cash flows, those change the value of the firm. Again, we'll bring this all together. So in their theory, we look at capital structure under 3 special cases. So we still have proposition 1 and 2, but there are 3 different cases that we'll look at proposition 1 and 2. So case 1, we assume no corporate or personal taxes. Obviously, this is not the real world, but this is a very common way to set up theory. We start with very simple, and then we add complexity on top of that to see if our theory holds and what effect it has. So with case 1, there's no corporate or personal taxes. There are no bankruptcy costs. With case 2, we bring in corporate taxes, but we still ignore personal taxes. And again, we ignore bankruptcy costs in case 2. So case 2 is a little bit closer to the real world because we can take into account corporate taxes. And finally, with case 3, we include corporate taxes. We still leave out personal taxes, but we also include potential bankruptcy costs. And so these are the different special cases, case 1, 2, and 3. And in each case, we can look at their proposition 1, which has to do with firm value, and proposition 2, which has to do with the cost of capital. So let's start with case 1 and look at propositions 1 and 2 under case 1. So proposition 1, the value of the firm is not affected by changes in the capital structure. This is their theory. The cash flows of the firm do not change, therefore the value doesn't change. So remember, proposition 1 was firm value. Proposition 2 had to do with the cost of capital. The WACC, weighted average cost of capital of the firm, is not affected by capital structure in case 1. So here are a few equations for case 1 that you'll want to be familiar with. We've got our weighted average cost of capital. This will look familiar, hopefully, from our 3250 when we had the weighted average cost of capital. But you'll see that we have our weight of equity times the cost of equity plus the weight of debt times the cost of debt. Now, there's one thing different with this equation compared to the equation we learned in 3250. The equation 3250 took into account corporate taxes. So we multiplied this second term for debt times 1 plus the tax rate. But with case 1, we're assuming there's no corporate taxes. So we can leave that out. So we can rearrange this and get the cost of equity equal to this new equation. So the R sub A is the cost of the firm's business risk. That is the risk of the firm's assets, or the cost of assets. So the R sub A minus R sub D times the debt over equity is the cost of the firm's financial risk. That is the additional return required by stockholders to compensate for the risk of leverage. Okay, so we've got equity. In an all equity firm, the cost of capital is the cost of the equity. However, when you bring in debt, there's an additional return required by stockholders to compensate them for the risk of that leverage, because it amplifies both the good and the bad, so it adds additional risk. And so that's why this term is included in that. So let's look at it graphically. So on the left-hand side, on the y-axis, we've got the cost of capital by percent. And on the bottom, we've got the debt to equity ratio. So as we increase debt, so we start off on the left-hand side with no debt, and then we start to add debt. And the cost of debt is going to remain the same. Our weighted average cost of capital remains the same. That's because as we add debt, there's less equity, but the cost of equity increases because we've added debt. And so it's equally proportionate. So that's why that pink line remains constant. Our weighted average cost of capital stays level and constant because as the cost of equity is increasing, we're using less of it. And as the cost of debt is less than the cost of equity in general. And so what we see is capital structure under case number 1 makes no difference to our overall cost of capital to the firm. So here's an example for case 1. We've got a little data here. So our required return on assets is 16%. So that's our WACC is 16%. Our cost of debt is 10% and the percent of debt, or debt over the total value of the firm, is 45%. So that would make equity being 55%. So what is the debt to equity ratio? So the debt to equity ratio is debt over the total value of the firm divided by equity over the total value of the firm. Or we can put this as debt over the value of the firm over 1 minus debt over the value of the firm. Basically, that's just telling us that it's going to be 45% over 55%. So that gives us a debt to equity ratio of 0.8182. So we'll come back to that. So what is the cost of equity? Using the formula from the previous page, we have the cost or required return on assets was 16%. Then we add that factor for the additional risk by levering our company, which is our cost of assets minus the cost of debt times the debt to equity ratio. So the cost of equity with this debt to equity ratio is 20.91%. So that's higher than the 16% if we had a 100% equity firm. So suppose instead that the cost of equity is 25%, what would the debt to equity ratio then be? So we could back into the debt to equity ratio if we know what the cost of equity is, given the fact that we know that what the required return on assets would be at 16%. So we can plug that in. 25% is our cost of equity equals the cost or return on assets, required return on assets. And we plug in that again, required return on assets minus the cost of debt, and we solve for debt over equity. So that is 1.5. So we're much more levered at that point, 1.5. So the more levered we get, the higher the cost of equity is because of that additional risk to shareholders. So again, in 3250, we covered CAPM, Capital Asset Pricing Model. So we're going to look at Capital Asset Pricing Model, the security market line, and Proposition 2. Remember, Proposition 2 has to do with weighted average cost of capital. Again, we're still in case 1, where we're assuming no corporate taxes and no bankruptcy cost. So what do changes in capital structure, what effects do they have on the cost of capital? So how does it affect our systematic risk? We can again use our CAPM, where we've got the cost of assets, and you should be familiar with the CAPM formula there. It's the risk-free rate plus the beta of assets times the market risk premium, which is the return on the market minus the risk-free rate. So beta of assets is the firm's asset beta and measures the systematic risk of the firm's assets. How does the firm compare to the market in riskiness, the firm's assets? In Proposition 2, we replace the required rate of return on assets with the CAPM and assume that the debt is riskless. So it's at the risk-free rate. So we can plug this in, rearrange our formula where the cost of equity is the risk-free rate plus the firm's asset beta times 1 plus debt over equity times the market risk premium. And so this will give us our cost of equity, much like we did that before. So these formulas, you should be familiar with them and should be able to plug in the information as given to you in practice problems. Moving on to business risk and financial risk. So this, again, formula was from the previous slide. As was this one, we've got CAPM, the cost of equity, where we can plug in the cost of equity is equal to the cost, the beta of equity, our equity beta, is equal to the beta assets times 1 plus the debt over equity ratio. So let me try and explain this in a way that might be a little bit more beneficial to you. When companies are looking at optimal capital structure, they are looking at the cost of equity. And the cost of equity is estimated based on the capital structure. And so we can look at the true cost of equity if we know what our debt to equity ratio is, but our cost of equity changes based on that structure. So the systematic risk of the stock depends on the systematic risk of the assets or our firm's asset beta or business risk. Also depends on the level of leverage, our debt to equity ratio or our financial risk. Okay, so again, we'll do some practice problems with these formulas, but take note of them. Let's move on to case number 2, looking at the cash flows. So you'll remember that in case number 1, we were assuming no corporate tax. With case number 2, now we add in corporate tax. And as we learned before in Finance 3250, interest is tax deductible. So there's a tax benefit that comes along with issuing new debt. And so that benefit is part of the what we consider with case number 2. So when a firm adds debt, it reduces taxes, all else equal. So this tax benefit, this interest tax shield, as we call it, has a value and does make a difference. So when we include taxes, corporate taxes in case number 2, it changes things a bit, and it may make it so that there is an optimal capital structure. So the reduction in taxes increases the cash flow of the firm. So how should an increase in cash flows affect the value of the firm? If there's an increase, the value of the firm should, of course, go up. So let's take a look at an example of case number 2. We've got an unlevered firm and a levered firm. Let's first look at the levered firm. So EBIT, earnings before interest and taxes, is $5,000. There's no interest because it's not levered, so they don't have any borrowings. So they don't have to pay interest. Their total taxable income is $5,000, and they have a tax rate of 21%. So they have to pay 21% of the full $5,000. Their net income is $3,950. And so the cash flow from our, in this case, is $3,950. So for the levered firm, on the other hand, you can see that our earnings before interest and taxes is the same, but we have interest. This interest affects our taxable income. It reduces it by that 500. So that then in turn reduces the number or the amount of tax that we pay. So our net income is less, but the cash flow from to the firm is actually it's higher, and I'll show you here in the next slide why it's higher. It's this annual interest tax shield. So the tax rate times the interest payment is our annual interest tax shield. So in this example, we were assuming $6,250 at 8%. That's our debt. We borrowed $6,250 at 8%. So we've got $500 in interest expense. So our annual tax shield is the interest expense times the tax rate. So it's $105. So if we go back to the previous slide, what's the difference between these two? The cash flow is exactly different by $105. So you can see that that interest tax shield increases the cash flow to the firm. So we can look at that and value it. With what the present value of our annual interest tax shield, we would assume for simplicity that it's perpetual. So we can use our perpetuity formula that we've learned and used in Finance 3250. So the present value is the tax shield, which is $105, divided by the interest rate, which we're assuming in this for simplicity's sake is 8%. And so the present value, the total value of this tax shield is $1,312.50. Now, we could also use this formula to calculate the same thing. What we end up getting is the same answer of $1,312.50. So we'll do some practice and have some practice problems that will help enforce this. Okay, so case 2, again, we're looking at some benefits as a result to our interest tax shield. We pay less taxes because of interest. So let's look at this, the value of the firm, which is proposition 1 under case 2. the value of the firm increases by the present value of the annual interest tax shield. So if we lever our firm, we borrow the $6,250, then the value of our firm increases because of this tax shield by the $1,312.50. So the value of a levered firm, V sub L, is equal to the value of an unlevered firm plus the present value of the interest tax shield. And again, this is a formula you'll want to remember, and it will be helpful to you. So the value of equity is the value of the firm minus the value of debt. So we've affected the value of the firm because of the present value of the interest tax shield. So we'll take the new value of the firm and minus the value of the debt, which should give us what is our new value of equity. Assuming perpetual cash flows, the formulas would be like this. The value of the unlevered firm is equal to EBIT times 1 minus the tax rate over the cost of capital for an unlevered firm. So the value of the levered firm is equal to the value of the unlevered firm plus the interest tax shield, which is the debt times the tax rate. Okay, so that is proposition 1. We have shown that the value of our firm under case 2 is increased by the present value of the interest tax shield. Well, how does it affect? Oh, here's the example for proposition 1. So let's throw some data out so we can see some numbers and try this out ourselves. So our EBIT, earnings before interest and taxes, is 25 million. Our tax rate is 21%. Our debt in this example is 75 million. Our cost of debt is 9%. And our unlevered cost of capital is 12%. So our cost of capital without any debt is 12%. So what is the value of our unlevered firm? We take the 25 million times 1 minus the tax rate divided by the unlevered cost of capital. So the value of our unlevered firm using these numbers is 164.58 million. So what is the value of the levered firm? The value of the levered firm, because we know how much debt we're going to borrow, is the value of the unlevered firm plus the debt times the tax rate, which is our interest tax shield. So the new value of our firm by borrowing is 180.33 million. So what is the value of our equity? The value of our equity in this case would be the value of the levered firm minus the amount of debt. So our value of equity is $105.33 million. Okay, so let's take a look at the proposition 1 with taxes. This is figure 16.4 in the book. On the y-axis on the left-hand side, it's the value of the firm. And on the x-axis, it's the amount of debt. So as we add debt, we gain the advantage of the interest tax shield. So the pink line is the value to the levered firm. So the more debt we add, the more valuable our firm becomes. You can see the value of the unlevered firm just remains constant. So the value of the firm increases as total debt increases because of that interest tax shield. And this is the basis of the Modigliani and Miller proposition 1 with taxes. So if this was the real world, we would want to borrow as much as we possibly could, because the more we borrow, the more the interest tax shield is, and the greater the value of our levered firm. Let's look at now the cost of capital in case 2, which is the Miller and Modigliani with corporate taxes. So the WACC decreases as the debt to equity increases because of this, we call it a government subsidy on the interest payments. We get this interest tax shield. And so the cost of debt is typically always lower than the cost of equity because of its advantageous treatment by the government when we're paying taxes. Okay, so the required return on assets now equals, and this should look familiar to you, this is the weighted average cost of capital formula. So it's the weight of equity, which is equity over the total value of the firm, times the cost of equity, plus the weight of debt times the cost of debt times 1 minus the tax rate. So looking at this further, we can then calculate the cost of equity. It is the unlevered cost of capital plus the unlevered cost of capital minus the cost of debt times the debt to equity ratio times 1 minus the tax rate. So you'll notice these formulas compared to case 1's formulas, the only difference is we've added that last term, 1 minus the tax rate. So here's our example. And this goes back to the old example. So the cost of equity is the cost of capital for an unlevered firm, which was 12%, plus the cost of capital for an unlevered firm minus the cost of debt times the debt to equity ratio. Remember, it was 75 million over the value of equity, which we calculated to be 105 million, times 1 minus the tax rate. So our new cost of equity is 13.68%. When it was an unlevered firm, it was 12%. But now because we add debt, our cost of equity has gone up 13.68%. So what is our WACC? What is our total weighted average cost of capital? Well, if we plug in these numbers based on these weights, you can see that the WACC has decreased. It's no longer 12%. It is down to 10.94%, and that is because the cost of debt is at 9%. And so you can see again how this might affect the value of the firm. The lower the cost of debt, the higher the value of the firm. So that is the theory behind case 2. Now we'll look at an example, case 2, proposition 2. Suppose that the firm changes its capital structure so that the debt to equity ratio becomes 1. That means it's 50-50. Half of the capital structure is debt, half is equity. What will happen to the cost of equity under the new capital structure? So we can look at this again. We've got our cost of capital for the unlevered firm, 12%, which is the same. And we take the 12% minus the 9%, which is the cost of debt. But the debt to equity ratio is now 1, whereas before it was the 75 divided by the 105. So you can see the more debt we bring on, the higher the cost of equity because it's additional risk to the shareholders. So they require a higher rate of return. So that's 14.37. So what would then happen to the weighted average cost of capital? Let's look at that again. So if the weights are 50-50, we've got the weight of equity times the cost of equity, and plus the weight of debt times the cost of debt times 1 minus the tax rate gives us 10.74. And what was it before? 10.94. So the more debt we add, the lower our cost of our weighted average cost of capital is, all the way up until we get to 100% debt, which would give us a 9% cost of capital. Here it is graphically, the cost of equity and the WACC. You can see the yellow line along the bottom is the cost of debt. That remains constant. The WACC, the more debt we add, decreases, and it'll eventually approach that yellow line. The value of the cost of the unlevered firm, obviously these numbers are different than the numbers we just used in the last example, but gives you an idea. The cost of capital for an unlevered firm is constant. The cost of equity goes up the more debt we add. And so you can see how WACC, which is what we will use to discount our cash flows to determine the value of our firm, the more it goes down, the more value our firm increases. So now finally, we're going to get to case number 3. You'll remember case number 3, we add in potential bankruptcy costs. So the more a company borrows, the higher the chance of bankruptcy. We looked at the effect of financial leverage, and in bad times, financial leverage, those fixed interest costs, if a company is not earning any money but they still have to pay the interest, they will certainly consider bankruptcy as an option. So we add bankruptcy costs. So as the debt to equity ratio increases, the probability of bankruptcy increases. And this increased probability will increase the expected bankruptcy cost. So at some point, the additional value of the interest tax shield will be offset by the increase in expected bankruptcy costs. And we'll talk a bit about what are the true bankruptcy costs, and some of them are easy to quantify and some of them are difficult to quantify. But what happens is we reach this point at which the value that was added by the interest tax shield is offset by the increase in expected bankruptcy costs, and then we reach a peak, which you'll see. At that point, the value of the firm will start to decrease and the weighted average cost of capital will start to increase as this more debt is added. So what are some bankruptcy costs? We've got direct bankruptcy costs, legal and administrative costs. It can be very costly to go through bankruptcy. Ultimately cause bondholders to incur additional losses. Typically in a bankruptcy, it's because they can't meet their interest payments and can't pay their bondholders, the people they borrowed money from. And so this bankruptcy cost is a disincentive to debt financing. It decreases the attractiveness. The more debt we bring on, once we reach a certain point, it's not attractive any longer to borrow funds. And this could cause firms to go into what we call financial distress. This is when they have significant problems in meeting their debt obligations. They can't pay their payments. Firms that experience financial distress don't always file for bankruptcy. They just have a hard time making their payments. Some additional bankruptcy costs, we've got indirect bankruptcy costs, which can be hard to quantify. They're typically larger than direct costs, but more difficult to measure and estimate. Stockholders want to avoid a formal bankruptcy filing. It destroys their value. Bondholders want to keep existing assets intact so they can at least receive the money that's there in a bankruptcy. So assets will lose value as management spends time worrying about avoiding bankruptcy instead of running the business. They'll not avoid, but neglect those things that would continue to bring in revenue. So the firm will likely lose sales, experience interrupted operations, and certainly valuable employees who could find a job at a more stable company will jump ship. And so these indirect bankruptcy costs are large, but hard to quantify. So here is our proposition 1 for case number 3. Remember, proposition 1 has to do with the value of the firm. So the value of the unlevered firm, it remains constant. That's the value of the firm with no debt, that yellow line. Then we've got the value of the levered firm, goes up, the blue line. But the actual value of the firm starts to decrease once we reach the optimal debt amount. And so the value will start to go down because of the cost of potential bankruptcy. And so you can see that this is the closest to real life that their theory brings us to. We've got corporate taxes and we've got the risk of bankruptcy costs. So at some point, firms will find this optimal amount of debt and try and stay within that range. And what we see in the industry, in in different industries, the optimal debt amount is different depending on industries. And some industries require a lot of upfront capital investment, like if you're a utilities company, you've got to put in all these power lines and other things. They are usually higher in debt than other types of companies. And so looking at the industry, most industries have kind of zeroed in on what is the typical optimal amount of debt, but there's no exact precise way of determining the perfect amount of debt. And that's because the cost of bankruptcy, those indirect costs, are very, very difficult to quantify. And so it becomes a little bit of an art. Once we get into the range, as a CFO, I had to determine how much debt was optimal. And I did look at competitors. I did look at the industry and to get a feel for that. But we zero in something that we feel is optimal. Okay, so looking at Proposition 2, which has to do with the cost of capital, our WACC, you can see the cost of capital for an unlevered firm remains constant, the yellow line. The cost of capital for debt, you can see with bankruptcy, debt starts to creep up. Once we pass the optimal debt to equity ratio, and we have more debt than we should, banks stop lending to us. Or if they do lend to us, the cost of borrowing is higher than if we were at the optimal debt to equity ratio. So what we see, we also see obviously, and this remains the same, the cost of equity goes up the more debt we add because of the additional risk to shareholders. So our optimal debt to equity ratio is the bottom of the trough for our weighted average cost of capital. That is where we want to settle in, because that's where our cost of capital is the least expensive. And so that is the magic number that we're trying to reach. And it can be difficult and challenging, but these concepts are very important for us as financial managers to understand, so that we can maximize the value of the firm by creating the optimal capital structure. So a few conclusions. Case 1, remember, it had no taxes or bankruptcy costs. So there was no optimal capital structure. Case 2, we added corporate taxes, but we still had no bankruptcy costs. So the optimal capital structure was 100% debt because we had the interest tax shield. Each additional dollar of debt increases the cash flow of the firm. Case 3, we add in bankruptcy costs to the corporate taxes as well. Our optimal capital structure is part debt and part equity, and it occurs where the benefit from an additional dollar of debt is just offset by the increased expected bankruptcy cost. And so we're going to reach a peak in value as we mess with our capital structure. So here are the cases. Case 1, 2, and 3 in the left-hand graph. You can see case 1 made no difference. Our capital structure really didn't matter if we added debt or not. Case 2, we wanted to add as much debt as possible. In case 3, we find that there is an optimal debt to equity ratio for our company. We have a similar slide with on the right hand side with our weighted average cost of capital, where under case 1 it really didn't matter. Our weighted average cost of capital was going to remain constant. Case 2, the more debt we add, the lower it would get. And case 3, there is an optimal debt to equity ratio that we're trying to hit. Okay, so some recommendations for managers. The tax benefit is only important if the firm has a large tax liability. If the firm doesn't have a big tax liability, then the tax shield is not very helpful. So in times of loss, if we lost money through operations in the year, then there is no tax shield because we're not paying any taxes because we lost money, we didn't make money. And so that tax benefit is only important if we expect to continue to make money. There's risk of financial distress the more debt we add. And the greater the risk of financial distress, the less debt will be optimal for the firm. The cost of financial distress varies across firms and industries, as I mentioned before. As a manager, you need to understand the cost for your industry. And so working in an industry, you get a feel for what's the optimal structure. Okay, so here we've got two different pies. In the extended pie model, the value of all the claims against the firm's cash flow is unaffected by the capital structure. But the relative values of claims change as the amount of debt finances increase. So on the left-hand side, we've got low financial leverage. You can see stockholders claim a lot more, but the more debt you add, there's less claim from stockholders, more claim from bondholders. And under case one, we assume that, that the pie doesn't change at all, the total pie. So the value of the firm is equal to the marketed claims plus the non-marketed claims. So these are all the marketed claims. The stockholder claim and the bondholder claim are the marketed claims. They're sold out in the market, so stocks and bonds. The tax claim, that comes from the government, and the bankruptcy claim comes from the cost of bankruptcy. So marketed claims are the claims of stockholders and bondholders. Non-marketed claims are the claims of the government and other potential stakeholders. So the overall value of the firm is truly unaffected by changes in capital structure, but the division of value between marketed claims and non-marketed claims may be impacted by our capital structure decisions. So the people we're trying to please are shareholders, and to a certain extent our bondholders. We want to, as financial managers, place maybe a little bit more on their claims. That's our role, but we should not forget that that there are other claims. There are non-marketed claims that do affect the overall value of the firm. One additional theory we want to throw in here, it's called the pecking order theory. And this theory states that firms prefer to issue debt rather than equity if internal financing is insufficient. So there's a pecking order. They'll pick debt over equity if they don't have enough cash. So rule one, they'll use internal financing first. That's cash generated through regular operations. Two, they'll issue debt next, and they'll issue equity last. So the pecking order theory is a little bit at odds with the trade-off theory. Trade-off theory, there's no target debt-to-equity ratio. Profitable firms use less debt, and companies like financial slack. Financial slack means they've got some breathing room. They're not always so tight. Couple of observations on capital structure. Capital structure does differ by industry. Differences according to cost of capital, 2010 yearbook by Ibsen and Associates. And we're going to just give a few examples here. The lowest levels of debts in 2010 anyways were drugs companies. So Pfizer and those types with 8.46% debt to equity. So they were mostly equity. Computer equipment, you've got companies like Dell or HP. That's their debt to equity level is 10% debt to equity. The companies that had highest debt levels, cable television, theirs is 193%. That's because they have to go out and install all of this infrastructure. So they use debt to finance that typically. Airlines, 177. Interesting, as I'm recording this, we're going through the COVID-19 crisis, and airlines have virtually stopped. How are they doing? If they have so much debt, the interest payments are fixed. They have to pay them whether they make money or not. Whether they fly those airplanes or not, they have to pay those payments. And so they are highly levered, and in difficult times like COVID-19, it severely affects these companies. Companies with the highest level of debt are more likely to have real troubles through downturns. I'll let you work the web on your own, but you can find information about a company's capital structure relative to its industry and sector on S&P 5 and the S&P 500 at Reuters. So there's some instructions on how to go about doing that. I recommend you just poke around and see if you can find these capital structures. We're going to end, this is the very last bit, we're going to end on the bankruptcy process. So in part one, the business starts to fail. Business has terminated with a loss to the creditors. Not starts, they have failed. They end it. So business is ended with a loss to the creditors. So that's business failure. There's a legal bankruptcy. That's where they petition federal court for bankruptcy. And then there's what we call technical insolvency. That's when the firm is unable to meet its debt obligations. So they can't make the interest payments and possibly not the principal payments. So that makes them technically insolvent, but they haven't gone into bankruptcy yet. Accounting insolvency is when the book value of equity is negative. And I did accounting as a financial controller for a company. They didn't pay me. They paid the company I was working for, but they had negative equity. They had huge losses that ended up making them putting them insolvent in an accounting way. And thankfully, the owners of the company, the shareholders, were able to come in and contribute some additional monies to make their negative value of equity positive again. Okay, part two, liquidation. Chapter 7 of the Federal Bankruptcy Reform Act allows for liquidation of the company. A trustee, it's usually a law firm, will take over the assets and try to sell them and distribute the proceeds according to the absolute priority rule. So debt holders get paid before equity gets anything. There's also reorganization. That's what we call Chapter 11. So you've heard Chapter 7, that's when the company is just done. And the courts will appoint a trustee to wind it down. Reorganization is when they intend to continue to operate. It's Chapter 11. And they restructure the corporation with a provision to repay creditors. And this, again, is done through the courts, where the creditors will fight for as much as they can get. The company will say, well, we can't pay. And the judge will typically come to some sort of an agreement with both parties, where the creditors may not get the full amount that they were owed, but they'd rather get something than nothing. And so it can be advantageous for creditors to have the company stay in operation so that they have a chance of getting something paid to them. With that, we'll end. I encourage you to do the quick quiz on your own. See if you can answer these questions. Look at your book, go back and review the slides and the presentation, and make sure you understand these things. If you have any questions, feel free to contact me during my office hours. Also, there's an ethics issue I want you to review and think about, and try and do the comprehensive problem. The answer for the comprehensive problem is in the notes of the PowerPoint slide, so you'll be able to see that. With that, best of luck. Thank you very much.